Interest rates are rising, inflation fears are on the horizon. What do you do as an investor in individual companies or ETFs? How do you manage a portfolio, and how do you make better decisions on what to invest in and what not to invest in? In this video, I'm going to take you through 4 reasons to avoid companies. So this would be before you've even invested, run the companies that you're planning to invest in or the ETFs through this checklist to determine if now is actually a good time to avoid these companies. The first reason to avoid a company is because that company sells a discretionary product or a commoditized product. And by that I mean a product or service that you can get from anywhere at any price. What tends to happen in an inflationary or higher interest rate environment is companies become more competitive on price. So that means if I sell a product and my friend next to me sells exactly the same product or service, think of a coffee. If I sell the same coffee as the person next to me, you're going to choose the one that's cheapest. Now that's important to understand, because if I have higher coffee bean prices or I have higher milk prices, I cannot pass that cost along to you as the consumer. So that means that me, the business in the middle, I have to eat that cost, meaning that I have to take a hit to my profit margins because I can't increase my prices. So conversely, if we're looking to avoid those types of companies, what we want to buy are companies with pricing power, the ability to increase prices and pass the increased price, whether that's from inflation or other things, back to you, the customer. Now you could be a customer like an individual, or you could be another business. If I can pass the cost that I'm facing back to you, my profit margins will stay intact. So remember, point number 1, avoid companies that sell commoditized products or products that you can basically just get from anywhere and you can substitute in or out. Point number 2, the second reason to avoid companies is, I would say, it's related to point number 1, brand value. If the company that you are investing or want to invest in has a strong brand wrapped around its business, that's normally a good sign. So we want to identify companies like that. Let's take an Australian example with Cochlear Limited, creates implantable hearing aids. Chances are, no matter the price, you're not going to want to screw anything into your head. So that's why Cochlear tends to do well almost all of the time, because people trust the brand. People know this brand for its decades-long experience and expertise being sold through trusted surgeons and reliable clinics throughout the world. So Cochlear has a very strong brand around its product or service. Once again, that relates to pricing power, but it also relates to demand. Apple iPhones are also another example of this, with their strong brand value and increased prices. Even if the economy falters, they're going to maintain their prices. And that's because they have such a strong brand. So for point number 2, remember, we're trying to avoid companies that don't have brand value or don't have some type of other intangible value. Healthcare companies are a good example of businesses that do have a strong brand. Number 3, supply side constraints. And this is where a business can't increase prices as a result of something that happens on the supply side of its business. So let's use Warren Buffett's example of baked beans. Warren Buffett says Heinz is one of the great companies in the world because it can take beans from anywhere in the world, it can put them in a can, wrap a logo on that and wrap a name on it called Heinz baked beans and sell that for more than the cost of the beans. The brilliant thing about this business model is that the beans can come from anywhere, but there's only one Heinz baked beans. Conversely, let's take an example of an Australian company called Redbubble. Redbubble makes custom t-shirts and designs. You can buy their products online. I own shares of Redbubble at the time of this recording. Redbubble has to pay for the increased cost of cotton. So if a t-shirt costs more to make, Redbubble has to take that cost and pass that back to the customer. The only problem is Redbubble can't pass that back, and it must get its designs from fulfillers or manufacturing sites that are near the customers. So it doesn't have the flexibility of getting beans from anywhere in the world and wrapping a brand around it. In fact, it has to be susceptible to those increased prices. Now, this is just one example, and there are ways for businesses to combat this. An Australian example might be Amcor, which operates around the globe. It's an Australian company, but it operates around the globe, and it does logistics and freight and those types of things. And it can pass on the cost to its customers, and you can see that in its financial results. So that means Amcor is a bit more insulated from increasing prices and increasing dislocation on the supply side. The fourth and final reason to avoid a company is not necessarily, relevant to this period, but to any period in investing history, which is avoid companies that are financially weak. These would be companies with lots of debt. If you look at the balance sheet, it will have long-term liabilities, and then there'll be a section in there that says interest-bearing liabilities or total debt or long-term debt. We want to avoid companies that have lots of debt and a little amount of cash, because during a crisis, companies that have more cash have more flexibility. Another thing you want to be mindful of is on the cash flow statement. That's another one of those statements that's buried in the annual report. Go into the cash flow statement and just make sure that the company has strong net cash from operations. Cash flow statement's divided into three. It's that first third, net cash from operations. Make sure that's a big positive number. The final thing that I might call out is when you look at a company's balance sheet, just have a look at how much intangible value there is on that balance sheet. So in the other section, I said how intangible value is actually really good. There is, however, one accounting standard that kind of catches people off guard, and it's called goodwill. When one company buys another company, what happens is if this company pays more than they should have for this company, what we see on this company's balance sheet is something called goodwill. Now, if a company has a lot of goodwill, what ends up happening, if they don't realize the full value of this investment, they actually have to write the value of that down. So the balance sheet might look like it's got a really strong asset on it, but then in a crisis, it all kind of unwinds. So what we're looking for in this section is companies with strong financial statements. So the first thing is lots of cash on the balance sheet and not much debt. And the third thing is go into that cash flow statement and look at the net cash from operations. If you're a little bit more adventurous, look at that intangible assets line and make sure there's not too much in the way of goodwill, because goodwill doesn't actually carry that much goodwill in investing, especially when there's a market downturn. So those are the 4 things to look for when you're trying to avoid companies in a high interest rate or high inflation environment. Remember that it's not all bad. We've got another video on market crashes, which should soothe those fears. Investing is a long-term pursuit. It's not from one year to the next. Of course, we've got to be sensible, but just remember to make your portfolio look like your best version of the future. Do that for long enough, and I'm confident that your long-term investing will take care of itself.